James is a Mississippi native. He is a member of the International Business Affairs Committee. He is also a two-term leader at AUP, faculty leader, head of the Faculty Senate. And he's also an extraordinary mentor of students. And I think a few of your students are even on this call, James. He's also a global explorer, I want to say in passing. As you'll see, he's married to a 2009 AUP graduate named Shantana, who was a refugee of the Cambodian Civil War and is now a French citizen. And he has two children who have triple nationality, US, French, and Kingdom of Cambodia. James attended Boston University and then studied in Tübingen and in Munich. He has a master's from George Washington and is working on a PhD from the Université de Paris. So he's studied everywhere, basically, in the world. I want you to know that at one point he did a stint as a fisherman in Sitka, Alaska, and then flirted with the idea of becoming a Benedictine monk. But luckily for us, he decided instead to sort of launch his illustrious career in finance, and then eventually over the years, I think you've been teaching for us part-time for almost 20 years, and in 2013 went full-time at AUP. So James founded McKenzie Ward, which was acquired by Alternative and Derivative Investments, ADI of Paris, which is a hedge fund. Then he joined AXA Investment Managers as head of high yield investments. And today he will be giving the third of 3 programs that we have done in this series, comparing the COVID-caused financial crisis to other moments, other historical moments, other crises. Marc-Olivier Strauss-Kahn talked about the 2008 crisis. Stephen Sawyer talked about the Franco-Prussian War, the end of the 19th century. And today, James, what are you going to be comparing us to this moment?
We're going to pick up actually on this year's recipient of the Professor Emeritus James Clayson Prize, Charles Beach, who's just a recent graduate and should be joining us or may have joined us already. He did a deep study of 1987, which was a period of a great crash as well. And I'm going to compare some of the conditions now with the 1987 contractions in the market. And this picks up on the 3 themes that we picked up on from Mark Strauss-Kahn, and then my colleague, Professor Stephen Sawyer. And then I'm going to continue it with yet another comparison of some of the market stresses here. Now, I always introduce with a little bit of a joke, as I have a face for radio, so mercifully I'm going to switch to slides in just a second here. All right, so I'm going to talk about historical market drawdowns and anomalies and implications for current market conditions. But this is part of a longer lecture that I do with my investment management students about crazy things that have happened in the markets that should not have happened but did. So that's why I use the rather broader title there. There is no one on the planet who should introduce a finance lecture without invoking Warren Buffett. So the question is why look at past market anomalies? And the answer is you don't argue with the Oracle of Omaha. And he's got a plethora of quotes that are useful out there. But this one is, in the business world, the rear view mirror is always clearer than the windshield. And I like that one, and that's apropos to what we're doing tonight. But I also want to say that Warren Buffett is also all in on the mission and future of the American University of Paris. One of his best quotes is, "The best investment you can make is an investment in yourself. The more you learn, the more you'll earn." And I think certainly AUP fits into that, although everybody isn't always just on the how much you earn as a measurement on there. Celeste has already introduced me, but I did have a long career before AUP as an economist and a securities analyst and an investment portfolio manager. I did manage junk bonds. I really don't mind the term. Other people use speculative grade or high yield. AUP, though, is the best place I've ever worked. The students, the faculty colleagues, the staff, the alumni, and the trustees, they're all great people. It really is the best place I've ever worked. But this fits in with my research because I like researching strange things that happen in the financial markets, and we'll get to a little bit of that. Okay, so the good news is this is going to be a little bit of fun, but the bad news is I can't make the math go away. To study finance, you need mathematics as a hermeneutic or an interpretive structure. to help make sense of the context that you're examining. And so we're going to be doing that a little bit tonight to help you understand things here. All right, so we're going to look at some of the largest historical market drawdowns and the advances. Then we're going to look at the relatively recent ones a bit more, and we're going to look at strong market anomalies during these crises. We're going to look at the March 2020 drawdowns in contrast to these historical observations. I'm going to specifically compare the 1987-2020, and we're going to come away with some observations and results, but our results are still inconclusive. So this is preliminary on this. In my conversation with Professor Stephen Sawyer, him being a historian, he always looks things and he says like, well, your conclusions are driven by temporal considerations here. So that's probably something to emphasize. So we're looking at time and the markets in tonight's subject. All right, now what are drawdowns? Well, humans tend to remember bad news more than they remember good news, and this is why the therapy industry exists and continues to grow. But drawdowns for finance people are percent changes that are negative in the markets. So just as an example that's obvious, but $100 investment becoming worth only $89, well, we tend to remember that because it hurts. We remember gains from 100 to 109, but psychologists say we don't remember these gains persistently. We don't remember them as well as our losses. So losses sting. Losses are part of our collective and personal memory if we're investors as well. So let's put the drawdowns that happened in March in context here. So this is the top 20 daily percent change losses in the Standard & Poor's 500 here. So the first one I want to look at is the March 12th, 2020, 9.5% drawdown. That was the sixth worst in history so far. And then on March 9th, there was a 7.6 drawdown, and that was the 19th worst in history. It was the 17th at the time. But the March 16th, 2020, 11.98%, or let's just round it to 12%. That was the third worst in history. Now, this table is a little bit boring, and the numbers are probably a little bit small on your screen. They're small on mine too. But if you go on the date column and look down the years and look at the drawdowns, there are 4 instances that occurred in 2008. Now, 2008 has been adequately covered by Mark Strauss-Kahn. So I'm going to look at a little bit of a different period. So that that's the 1987 drawdown. And we'll take a look at those, but you can see that there are 4 drawdowns that happened in 2008, and so far we've had 3 drawdowns in 2020. So will 2020 beat 2008 for 20th largest drawdowns on that? All right, well, I don't think it's escaped anybody's attention from looking at the news that we've also had some advances in March as well. So the March 13th, 2020 9.3% advance was the 10th largest in history, and that wiped out the previous March 12th day's loss. And then the March 24th advance was the 9th largest in history. And these collective drawdowns between the drawdowns and the advances, that made March on a percent change basis from strong to weak to strong. That was the most volatile month we've had as a single month in history of financial markets, strangely enough at this point. Now that's on a percent change basis. There's other volatility measures that would not be true, but for that basis. All right, so this chart may look a little bit confusing, but this is an annual drawdown. Now, what I've been talking about so far are daily drawdowns. So this goes into the how do we look at these things within time? So we're going to be looking at the frequency of losses. So you can look at the frequency of losses on a daily, a weekly, a monthly, or annual basis. And I think everybody who's been an investor has lost something on a year-by-year basis. So this from 1956 to 2015, and sorry this isn't updated, but this helps make 2 points that I wanted to make on here. These are drawdowns that happened on an annual basis, and the blue bars that are going downward, that's the S&P 500. The slightly light blue is the DAX, and the darker gray is the FTSE All Share. Now, the first thing I want you to notice is going from the S&P 500 from 1956 to 2015, as you look at the different markets, you will see that over the years, the markets started to have what we would call a higher correlation with each other. In other words, if the S&P moves down, the DAX and the FTSE and the TOPIX also move down, and they move together on a relative basis about the same. And that increases as time goes on, and that continues today. So this is something we need to understand and understand in contrast to Stephen's talk. In Stephen's talk, information about markets was disaggregated. So London may be different from Paris, which would in turn be different from New York City. But increasingly, global markets, they all move together, and increasingly strongly and increasingly on the same percentage basis. So that was the emphasis that I wanted to talk about there. All right, so let's take a look at remembering some basics from statistics. And remember, I warned you I can't make the mathematics go away. So this should be obvious, okay? So we've got a mean, and then we've got a single standard deviation between this. And just to explain something that everybody can understand, anomalously, I am exactly the average height of a male in the United States. I'm 5'8" and 3/4 inches, which in the last time I measured, that's exactly the mean height. And so one standard deviation taller than me would be my friend Stephen Sawyer, who's about 4 inches taller than me, and he's 6'1". He's tall. And somebody 1 standard deviation shorter than me, they'd be about 5'4". So this is the bell curve that explains the amounts of data, and 1 standard deviation explains plus or minus over the mean. So we all understand that. So now let's take a look at the formula for the bell curve. And I'm not going to dig in, this isn't a math lecture, but there is a formula behind the bell curve, and it does use the mean, and it uses the standard deviation. And one of the fun things about studying mathematics is the number pi and the number e of these transcendental numbers, they show up in pretty much everything. All right, so we've refamiliarized ourselves with this. So the question then becomes are financial returns part of nature? So if financial returns are part of nature, then we would expect a normal distribution of positive returns and negative returns over a very long time period, over history. And more importantly, we would expect very small changes to happen daily and very large daily changes to happen very, very rarely, very, very rarely. They would be at the extreme tails of a normal distribution. So if we begin to start thinking like a statistician, each day, the price in the market changes. And statisticians think of each of these daily changes, either positive or negative changes or staying the same, as a trial. Now, flipping a coin once is a trial, and the outcome is either heads or tails. So if we consider each day's return and count how many times the trial outcome occurred, that gives us the number of outcomes where the market gained 0.01% or lost 0.02%, or gained a little bit more than that, or lost a little bit more than that. And we count up the number of these trials where these outcomes happened. So if we expect the market to behave like other things we see in nature, the set of all outcomes should look pretty much like this, near the normal distribution. So, okay, this begs the question, what does history really look like? So this is my sense of humor, which may not convey very well over Zoom, and I apologize if it doesn't, but get ready to set your faces to statistical stun. This is what the distribution of daily percentage change returns in the stock market looks like. Those are the blue bars. Now, the normal distribution prediction is the red line. We would expect it to look like that. So what is this saying? Well, for a statistician, this looks crazier than a Dionysian orgy in a Carthusian monastery. This says that even more than most of the time, financial markets are as dull as dry wheat toast. They don't change very much, more than most of the time. And then they have unexpectedly frequent episodes of schizophrenic ecstasy or damnation. So our large drawdowns and our large gain days that I illustrated in the charts above are at these extreme tails. In the blue circle on the left, those are our top 20 daily losses, and statistically, they should not exist. Now, the scale on this is a little bit hard to read, but if you squint a little bit, you can see the blue bars emerging above the red line there. And each time you look at one of those, there is an instance where there were 1, 2, 3, 4, or 5 times where there was a market drawdown. Again, I'm looking at the left, where there statistically should not have been. And then looking at our top 20 daily gains, those statistically also should not exist. There are more of them than a standard normal curve would explain. So I hate to say this, but it's pretty easy for quants to draw this and make bets appropriately. It takes time for these bets to pay off, but they pay off well when they do. And Ray Dalio and Jim Simons and Paul Tudor Jones and Paulson have all made tremendous gains in very short-term periods by betting precisely on these ways. All right, now this is a little bit harder to read, but bear with me on this. Now, first of all, take a look at the y-axis. That's the one that's going vertical. And this is a logarithmic scale. So it's going from 0.00001 all the way up to the number 1. And then after that, the next increment is 10, then 100, 1,000, and 10,000. Now, those of you who are familiar with the earthquakes know that the earthquake, the Richter scale, is also a logarithmic scale. All right, so what's interpreted here is each time there is a single instance of a gain or loss of a certain amount of money, that's in the markets, that's depicted in the blue dots. That's the actual returns that are happening in the marketplace. So those are the actual returns that happen in the marketplace. Now, the red line is actually a normal distribution prediction, but scaled into this logarithmic scale. In other words, the tails don't go out to infinity. Instead, we're bounding the tails at this incredibly rare event. And the incredibly rare event of 0.000001 is an event that would occur once every 100 million years. Now you can see from looking at the blue observations, and the reason that they're on the 1 axis and clustered around the 1 is we are observing at least one of these instances. But if we map where they are and the gains, now looking at the x-axis, that's the returns that occurred. If we look at the x-axis, the example that I pulled out of there is a 5.5% daily move should actually statistically only occur about once every 670,000 years. And the market returns indicate this over and over again, where we have very strong, very anomalous returns. All right, that's a little bit deep, but there's plenty more of this kind of stuff if you would like to come to AUP and study with me. All right, so now we're going to look at the past. We're going to look at 1987, and we're going to see if we have any insights for now in 2020. Now, this next section comes from the honors thesis of our recent graduate, Charles Beach, and I may get him to comment at the end of this, presentation. All right, so the largest single-day drawdown in U.S. history was Black Monday, October 19th, 1987. At that time, I was actually testing a vocation as a Benedictine monk, so I missed it. But anyway, the market plunged 508 points, and I saw a few people on their screens, and there's plenty of us who remember this event. I just missed it for some pretty strange reasons. But anyway, so we had a drop of 22.6%. So looking at the largest single-day drawdown in U.S. history on this scale, this looks very dramatic, and those of us who lived through it certainly remember it. And the data I've selected here and the scale of this graphic and the time period observation, it looks like the stock market plunged and then reset itself to a new permanent low. That's what it looks like. All right, well, academics continue to look at this drawdown in 1987, and there are three key factors that schools of thought that are attributed to this fall. So one is, this was a period of the tremendous leveraged buyouts, and this was Ivan Boesky and T. Boone Pickens and all of those sorts of activities. In addition to that, indices were growing, and in addition, mutual funds that invested in indexes were also growing. So there was a tremendous industry of index arbitrage, sort of proto-hedge funds at that. In addition, there had developed portfolio insurance. Now, that's a compressed name that describes something. And for those of you who would like to get into the technical parts of it, I can explain it further offline. But portfolio insurance is largely what we would call a zero-cost collar. In other words, you give up some gains that may happen in exchange for capping the amount of drawdown that you'll have. So portfolio insurance was something that was largely being sold to many mutual fund and pension fund managers. So taking a look at the state of the economy in the 80s, well, the economy in the 80s was actually quite robust. Things were growing, the S&P was growing, the S&P 500 was growing. So there was tremendous growth and tremendous optimism. So from 1980 to 1987, pretty good years. But let's take a look at this scale. So from 1984 to 1989 and take a look at things. So the first thing I'd like you to look at, and my excuses for the primitivism of this, but sometimes clear, simple graphics explain a lot. Let's take a look at real GDP growth. Now, real GDP growth are the little boxes, those are the little squares, and there are dots along there. So real GDP growth is observed quarterly. And if you look at real GDP growth and look at the little squares and you draw it, you say, like, okay, basically GDP from 1984 to 1989, it seems to be consistently going up. It doesn't change a lot. There isn't a lot of variance. It doesn't, it's not very volatile at all. The next thing to look at is our drawdown in the S&P 500. Now, the S&P 500 is the line with little diamonds on there, and that may be a little bit hard to read on your screen, but it starts at around 47 in January of 1984. And if you can follow that line, you can see that it peaks and then has a sudden dramatic drawdown in October of 1987. And then after that, it continues on in a little bit of a varying pattern, but at a new level. All right, but the next one that we want to look at is the triangle line. Now, the triangle line is the spread in bonds. Now, when we talk about bonds and finance and the spread, we're talking about the difference between what good quality corporate bonds pay over what the federal government pays. So if the federal government is paying 5% and a corporate bond is paying 7%, we would say that there's a 2% spread, or in the business, you'd say 200 basis points. So that's the spread. So monitoring the spread is an indication of how confident people are in corporate success and government success. So if you're feeling nervous, you retract and say you'll only take 5% rather than loaning money to a corporation at 7% because you're not sure you're going to give it back. Now, strangely, a collapse in spreads often is indicated and said like, oh, well, that's not good for the market, because if corporations are only borrowing at a little bit more than the government, then corporations start saying like, well, gee, it's very hard to borrow because the government's paying such high rates. They're crowding us out. They're crowding out our ability to borrow, but we can't charge higher rates or nobody will buy our bonds. So collapsing spreads have a lot of implications about where investment money is going to go on a borrowing basis. Much bigger story than we can cover here. All right, so the state of the economy in the 80s was also the high yield heyday. This was the period where high yield bonds were no longer fallen angels. In other words, formerly investment grade bonds that had become junk bonds. But this was the birth of the period of an original issue high yield bonds. So this was the high yield heyday. In addition to that, there were tremendous changes in the demographics. This was where the baby boomers transitioned from being largely consumers to starting to be savers. So there was a large influx of new investors in the market. Mutual funds mushroomed everywhere. All sorts of investment vehicles happened. All right, in 1987, globally, there was a weakening of the dollar. There was a rise in interest rates. There was a growing US deficit, and that was very much in the headlines. And there was a bond market crash in March as well. So these are the players that were happening. So January, February, March, the bond market has a big crash. So the week preceding the crash in the equity markets, well, every time Congress says that they're going to do something, the markets move and react. So there was a new Ways and Means tax bill proposed. It seemed to have a lot of legs. It seemed like it may go a lot of places, and that would change the tax structure of both households and corporations. In addition to that, the options market, there was tremendous volume pickup in the option markets. And in addition to that, there was a tremendous pickup in the volume of program trading. So much so that the week preceding the crash, the order flood was overloading the DOT. Now, the DOT is the designated order turnaround, and that was a telecommunications system with human nodes that was making and then confirming that a trade had been made. Now, we forget often nowadays with the kind of technology that we have, that back then we did have telecommunications and we did have sophisticated computers, but there were a lot of nodes where all these things were happening, and those nodes could be weak. So then let's take a look at the crash itself. Yeah, that's how everybody felt, and that's a picture from the day, I understand. So let's take a look at the volumes of program trading and look at October 15th, October 14th, 15th, 16th, and then 19th and 20th. And you can see, and by the way, October 14th, 15th, and 16th, those were days, Wednesday, Thursday, and Friday, that picked up quite a lot of volume. But you can see that on October 19th, the volume just exploded from program trading on the total New York Stock Exchange volume and the total S&P volume. If you look down at the bottom percentage that was driven by program trading, you can see that there was a tremendous explosion driven by portfolio insurance. As the market contracted, more portfolio insurance programs were triggered, and therefore there were additional sales on sales into a declining market. And the volume of portfolio insurance trades compared to all the other trades increased tremendously. Now you can see on October 14th, 15th, and 16th, the portfolio insurance trades only made less than 1% on the 14th, 2% on the 15th, but already going from 2% to 9% on the 16th, something was happening. And on October 19th, there was just a tremendous floodgate of portfolio insurance trades. All right, so this is the 5-year intervals of the day leading up to, and then October 19th. And something we often forget was we had a tremendous amount of tension between the United States and Iran during this period. Those of you who lived through this period will remember that. And there was an Iranian missile that hit a US tanker, and oil was the lifeblood of the United States at this time, probably still is, on October 16th. And so that was the news on Friday. On October 19th, there were 2 warships that shelled an Iranian oil platform in the Persian Gulf. So again, we've looked at program trading, but in addition, outside of program trading, there were also world events that were influencing these things. Now, the rest of the ticks in the timeline were events that happened as the day unfolded and what people did in response to the declining market. But there were, you can see, these are 5-minute intervals in the market, the tremendous decline that happened on this. So Tuesday, October 20th, this was a make or break time for history and for the Federal Reserve. Now, in addition to the trading that happened on the 19th, on the 20th, before the open, there were a tremendous number of margin calls. Margin calls are where if you've been trading at 10% or 20% down and then leveraging into a position, if you'd had a declined position, you would need to deposit more cash to make your positions whole. If the margin calls did not get the additional influx in cash, then all of those positions would automatically sell. So there was tremendous pressure for a possible further crash as the market was beginning to open on Tuesday, October 20th. So the fallout from this. Well, what we've done here, and this was part of Charles's thesis, is we've isolated 2 dates. And those are the black lines on this previously shown slide. And we're looking at that big jump that occurred in the market, and then the tremendously steep decline, and then the continuation of the market. Now, here's where I want to reintroduce the real GDP line. Let's take a look at that real GDP line and its real slope. And notice that during the period between the 2 black lines, the 2 black vertical lines, the real GDP didn't decline. So Charles's thesis was, well, if we just lost the data of this tremendous period and drew lines from the observed point that we've got to the next observed point, in other words, we didn't know what went wrong, we would still just say, okay, well, there was a decline in the bond market, but real GDP increased. And then the financial markets kind of chugged along at some point in here. In other words, if we'd erased this data, if we'd just taken this data away, we could arguably just spline or connect these dots, and we wouldn't know that this tremendous story had happened from the data that we've observed. It's only because we did observe these things that we do see this. So then the conclusion in that instance is the March 2020 March crash was from historic highs. February 19th was an S&P 500 all-time high. And after that, as we entered into March, there was a decline, and some would say there's just a natural decline in March. But then after that, we had our crash days and our advanced days. So the conclusion from the historical drawdowns and recent drawdowns are, well, where are we now? Well, we're not as high as we were, and we're certainly neither as volatile nor as low as we got. And other markets like the VIX and the SOPAR and the shadow LIBOR market all tell equally interesting stories in this very complex time that we're living in. But every historical drawdown also has some sort of story attached to it, either portfolio insurance, or war in Europe, or pesky derivatives, or plague, as Stephen pointed out, or over leverage, or corporate shenanigans, or changes in political structure. And ours right now is COVID and tremendous civil unrest. But we are, statistically speaking, back where we were. So could we just think of COVID as this? And history would argue that this is okay, but we as human beings, of course, judge things under different criteria. And we also look at the information that is embedded in here and try and get more of the story from there. But frankly, if we'd had March data wiped away and we just observed June data, for example, and we didn't have that data, and we didn't know what was going on, and we suddenly in February, at the end of February, we knew what the market was, and then suddenly in June we knew what the market was, we would have no consciousness of the fact that the market had this tremendous drawdown, and then these advances, and then this slow climb backwards on that. So that's this leaves the conclusions are that, you know, the jury's out on this sort of stuff, but we can look back at the 1987 market and say, like, if we erase this period, it doesn't really change the data that we've got now. So with that said, this is a good place to take a break and answer any questions.
We have a couple of questions that are definitely, I think, of interest. You're good students here. So the first one is actually a pair of questions that came from our board member, Achim Kluber, who asks, first, from Professor Ward's perspective, do hedge funds speculating on a rise/fall of equity markets increase or decrease volatility of the markets? And is there any academic work on that? I'll let you stop there, and then I'll ask you a second question.
Okay, yeah, I'm sorry, could you repeat that, because I was having problems with my screen, so I accidentally turned off my microphone. So pardon me on chewing up everybody's time on that. So.
Okay, no problem. From Professor Ward's perspective, do hedge funds speculating on the rise or fall of equity markets increase or decrease the volatility of markets? And is there any academic work on that question?
Okay, so the first thing is, yes, there's tremendous amount of academic work on that, and the jury's still out on that. And let me phrase this by saying, with options, you can make bets just on volatility. In other words, you can bet, I don't care if the market, goes up, and I don't care if the market goes down. All I care about is that the market moves. If the market stays the same, then you lose money, but you can actually make a positive bet that market's going up or going down. Now, the question then becomes is, in a market of equilibrium where everybody's got equal amounts of information and is equally making rational bets, could people say, no, I think you're wrong. I don't think the market is going to go down. I don't think the market's going to go up. I'm betting on that fat middle that I illustrated in my talk, as I think markets are just going to be boring and stay the same. By the way, the techniques to do this, and I don't mean to bore you, but if you want to send me an email, I'll be happy to send them to you. And I'll send you spreadsheets where you can do exactly these trades. These are known as bull spreads, butterfly spreads, and strangles. And I can show you exactly how to make these bets in the option market if you want to bet on increased volatility or less volatility. I can show you exactly how to position yourself on that.
Well, I can speak
about hedge funds.
Yeah.
Hedge funds are doing things that ordinary investors could have done, but they're doing them with what is known as sophisticated money. In other words, they are not constrained under the constraints. They can act as if all of their investors are only sophisticated investors, and sophisticated investors are presumed to have the wherewithal to know about the risks that they're taking. Whereas the idea of a fiduciary duty in a mutual fund, if you are a fiduciary and you're managing a mutual fund, you can't take risks like that because you are investing on behalf of people who are not presumed to know what it is that they're investing in. They're asking you to do it for them. So that means you're very highly constrained from taking and the prospectuses frequently limit mutual fund managers to doing only the tasks that they are defined by doing. Whereas hedge funds, by definition, a true full freedom hedge fund can do whatever position they want. They can take whatever position they want.
Well, I can speak on behalf of someone who this lecture has taught many of us in this call why we don't get involved in a sophisticated way, but obviously Achim does, because his second question is it possible to speculate on the correlation of the Standard & Poor's versus DAX, i.e. on one leading or lagging the other on a consistent basis, or one having a higher volatility, the other a lower?
Yeah, yes, and the answer to that is yes. These are known as correlation and dispersion trades. So you either go long correlation, meaning you think that the members of the index are going to be highly correlated, or you go short correlation. In other words, you think that the members of the index are going to no longer dance very well with each other. I'm getting excited because the second half of the lecture, which would take another hour, actually ends with his question, where at one point in history, the correlations for all the members of the FTSE 100 was 1.2 positive. And that actually is mathematically impossible. And I would love to show him that. But it would take another hour to get there and a bunch of math, but it's a lot of fun. It's really is hilarious to see that. Now, the trade only existed for 10 minutes, but it did exist.
Wow. A statistician, real moment. And we'll connect you to it directly. Our next question comes from Oliver Spencer, who is a parent who has had questions regarding all the topics of these features. Really amazing breadth of knowledge. Ollie, thank you for joining us. How did the market respond to the federal government stimulus plan? Positive or negative? Short or long-term effects?
Yeah, I would have to say now you're beginning to get to the point where I'm more of a consumer of news and an actor just like you. There are people who specialize in political economy and are Fed watchers and watch the macroeconomic effects of that. And certainly I watch them from a trader's perspective. But one of the things, and actually let me direct you to a resource. Ray Dalio has a very good 15-minute YouTube video about precisely this topic. And one of the things that is one of the problems that happens is when you have interest rates that are extremely low, of like 0.5 or down to 0, the Fed no longer has a lot of power to be able to influence items that they ordinarily would have in their control to help the economy, either on the terms of their two mandates, which is employment and inflation. So once you get to interest rates 0, there's really not a whole lot else you can do, even with open market actions. So when you do things like take open market actions, it has a decreasingly powerful effect. Now I do observe that. So I would say the jury is still out on whether quantitative easing is going to end up having long-term benefits for it. Quantitative easing is ultimately inflationary, but the wonderful thing about going through deflationary periods and inflationary policies is to try and keep them in equilibrium. If you keep them in equilibrium, and Ray Dalio says this even better than I do in 15 minutes. Great video, great graphics, just highly recommended. And he walks through all of the different weapons that the Fed has. 15 minutes well spent, better than I can explain it.
Great, and Charlie just posted that on the chat. We'll send these links out after this too, when we send the thank you for coming email. We'll have a few links to share with you. That's great, thank you. Our next question comes from Beth Kurth, who notes some of the market drawdowns are market related, i.e. portfolio insurance, and others are economy related, i.e. war in Europe and today COVID. Do you think about these types of impacts differently?
Yeah, one of the big problems that I have explaining what I do is because I'm really a mathematician who looks at markets, I'm a little bit distant from the explanations that are the narrative of history. So in one way, I first want to look at things and I go like, oh, there's a series of numbers, very interesting. And I want to examine them from a mathematical standpoint and a percent change standpoint first. Then afterwards, when people attach narratives or say, this is the explanatory thing, I want to go back and say like, well, let's test that as a thesis or a hypothesis afterwards. So, yes, the uncertainty that people had about the future because of COVID is definitely a very, very strong explanatory power on the markets. But I first need to go through and say like, well, statistically, is this a big drawdown? And the answer is yes. And then after that, I say, okay, it's a big drawdown. What was happening at that time? Now, that's why 1987 is so interesting compared to now, is we actually have a lot going on now. We have civil unrest, we have COVID, we have maybe the end of quantitative easing as a policy. We have a lot of open political questions in the United States. We have a lot of open economic questions in the United States. So all of these factors could be explaining the market. Is this a frothy thin market at the top? I don't have an answer to that. Like anybody else, I watch the news and my heart breaks. But then I go to work and I look at the data and I say, my job is to look at the data. And so that's what I do.
Great, thank you. James, would you be willing to put your camera back on so we can see you while you're answering these questions?
Sure, I didn't know that it was off. Sorry about that.
Thank you. Thank you so much. It's just so much. It's great to see you while you're talking. And our next comment comes directly from your last one. It's perfect. And it's from Ray Henze, our chair emeritus. James, thanks. Great. If we had not experienced COVID and civil unrest, you just referred to these, of course, can you look at the highs recorded in February and predict that the market was ripe for a large drawdown and could have been tipped into it by a whole range of events, such as an international military event or political actions?
Yeah, one of the, Ray knows this, and just for the audience of everybody else, very typically when you get very toppy markets, and history has borne this out, is in addition to the top, you're seeing and observing a high price, but the volume thins out at the top. Now that makes sense just off of a mountaineering metaphor, right? I mean, the further you go to the top of the mountain, the thinner the air gets. So there's fewer and fewer trades. So a lot of people do correlation analysis of how much volume traded at those very high prices, because if there's a bunch of people trading at those very high prices, meaning there's a bunch of people who strongly feel that those prices are valuable and that's why they're willing to pay them, then that indicates that that might be a trend that's continuing, or that's a very solid valuation of the discounted cash flows of the equity markets. But when the trades thin out at that basis, then that might be an indication of toppiness. Now, to answer Trey's question directly, I've actually not done a metric analysis of the volume of trades. And the other thing about volume of trades is because more people participate, you have to scale the volume of like the volume now versus the volume in 1950. So you've got to, like, very much like an inflation deflator, you've got to say, well, this level of volume actually means something versus this level of volume from the 1950, I actually haven't done that, Ray, and I am looking forward to doing that this summer as soon as I get a breath of fresh air.
That's what summer vacation is for when you're a professor. That's exactly right.
I know my friends, my friends who are hedge fund managers still, they already know the answer to this, but I'm not there anymore.
Yeah, no cheating. You have to do the work yourself. Are there other questions? Charlie's on the call. I wondered if you wanted to put him on the spot at all.
I think Charles, because I built off of, and we worked very carefully together on his honors thesis, and I was so pleased with the work he did. I would love if he would get a few minutes to present to you guys some of his ideas that he learned from this as well, or take apart some of the conclusions that I made, because he's perfectly capable of that.
That's perfect. We have about 5 more minutes, Charlie, so please.
Hello, can everyone see me?
Yes.
Okay, so I don't have too much to add. I think Professor Ward explained it all very well. The only thing that I would say is the biggest takeaway is the fact that real GDP was rising in 1987. There wasn't really an interrupt to the macroeconomic cycle that affected the downturn in the markets. Well, here today, we're seeing downturn from, as he said, greater civil unrest and real economic drawdown. And I don't think that we're seeing that accurately reflected in the market, but that's, I mean, I'm not one to speak to that. I haven't done really the analysis, but just from a gut feeling perspective, it doesn't seem reflective of the economics in such a new way, which we've never really seen before. So that's why I think that this period, when we have that rear view mirror perspective of it, will be very interesting. Other than that, I don't have much else to add.
I think as a person who now studies markets, this is a tremendously fruitful area for continued study, and I'm going to come up with a new answer every single day. So I don't want to mislead everybody in saying, like, this is the final answer. I'm not a person like that. I've looked at everything. I'm continuing to look at more things. I think there's going to be more explanatory power. It helps because I'm not in the markets trying to make decisions about people's investments in the midst of it. It's fun to be in this chair nowadays where I can look at it from a distance and then try and analyze it and try and give some perspective. Frankly, I can't even put myself in the mindset of what I would be as a high yield trader in the current conditions. I really couldn't. I'd have to really re-engage. So everybody forgive me that I don't have a strong conclusion that says you should do this. I'm not that kind of guy.
Well, James, as you know from your participating in Stephen's call, we always finish with a concluding question with a thought for people to take away. So I'm going to give you this one last question from a 2012 alum, Mark, who's on this call, who's asked a question we all want to know, and maybe add to it anything else you'd like us to take away from this call. The question is this: Hi, Professor Ward. Unfortunately, I missed you as I'm a 2012 alum, although I imagine you would have been a pleasure to have in class. I think we all know that now. My question to you is whether or not you see the markets bottoming out once again in the near future, presumably after the COVID scare passes. Thank you for your time.
Well, I think my first answer is I'm 58 and I watch my retirement fund very carefully at this age. So if the market bottoms out anytime soon, I'm going to be changing retirement plans pretty dramatically. The other thing I do is, I'm a big sort of person on this. Although I was an active investor for the majority of my career, I was a bracketed investor. I invested in only high yield bonds, so I had that universe. So my job was to try and pick which investments within that set of choices. But in my personal investing, I'm not a very active manager. So I don't say the market is going to bottom out, or I don't say the market is toppy or anything like that. Like most people, I'm a long-term investor. I've got a Vanguard fund where the majority of my retirement savings is. I invest for the long term. Now, I do have some positions that I say because I've figured this out or I've figured that out. But the majority of everything I do is I realize that I can't predict the biggest part of the market. I can predict my little share, and I can look at my little share when I'm doing that as my full-time job. But the rest of the time, I can't say the market's going to bottom out now or the market's toppy or anything like that. The market over history has done such crazy things, kind of like what I've shown you. I really think the idea is you really should invest for the time sequence that you've got, and a 30-year investment plan or a 15-year investment plan or a 10-year investment plan, and then stay invested and do like Warren Buffett does, which he says, if the stock market closed for 4 years with the things I'm invested in, I wouldn't care at all. And I agree with that very, very strongly.
Well, that is a classic answer we can all take to our next Zoom call with friends. So that's a wonderful way to end a really interesting and fascinating presentation where we also can all say we learned statistics again today. So,
there's more.
We know that. Thank you so much for your participation today. Any last comments from anybody in the chat bar or want to raise your hand?
Thank you, everybody, so much for coming.
Thanks.